Always trying to get that last sip in. How you doing, friends? Good morning. This is the 0DTE Morning Market Analysis, and I'm Coach Ernie, also known as the Dude from Earth. And you're tuning into the market's echo on this pivotal FOMC day. Now, if you remember yesterday's live stream, we positioned for that potential drop, and boom, it hit spot on. But let me make something very clear. Folks here made a lot of money on that drop, on those asymmetric bets, and we're still sovereignly placed for more downside if this tension builds. But remember, this isn't prediction; it's pure convexity. What does that mean? What is pure convexity? It means that we're placing our bets in such a way, asymmetric bets in such a way that if our prediction or our positioning is correct, we make huge money. And if we're wrong, we lose a tiny, tiny little bit. Small risks for huge payoffs. And that preserves wealth no matter what the twist, no matter what happens. With markets in thin air at these highs, volume a shadow of the tariff scare days, the real story is unfolding. And here it is. Trump's tariffs are proving a masterstroke in global deals. You can see this in a lot of the pundits that were steadfast against him are now starting to turn and look back on themselves and say, hey, maybe what he's doing is working. Of course, you always have those detractors, and they'll be forever. But the fact is, it's a masterstroke in global deals, and it's defying Powell's inflation fears and the media's doomsday wishes. Which is, I don't understand. Well, I understand, but it's at some point they have to give it up. They have to see what the reality is and start speaking to it. But let's unpack the macro mastery and spot the edges so that we can all harvest those gains together and hold on to our sacred capital. All right. The macro story is alive and kicking. Yesterday's drop was the first chapter in the tariff FOMC saga, and, well, today, as you know, is FOMC day. And our asymmetric positioning nailed it without locking into any kind of crystal ball. Now, we called the potential of a 2 to 3% slide based on structural voids and the narrative tension, not prophecy. And it delivered profits while keeping risks tiny. Now today, as the FOMC looms at 2 p.m. this afternoon, Eastern Time, we're still convex for further echoes south. What that really means is that we're still, with asymmetric bets, our cost of those bets are super low with huge potential. So if Powell doubles down on his unproven tariff inflation dogma, ignoring the deflationary wins Trump keeps scoring worldwide, like the EU deal that he just inked, and like pacts that cool prices and strengthen, those will, I'm sorry, let me rephrase that. Those trade pacts, they're going to cool prices and strengthen our hand. It's a brilliant negotiation at work, turning supposed threats into economic booms. Yet the Fed's stubborn, unbelievably stubborn, the media is piling on. They're in dismay. And at the same time, there are breaks within that whole genre that are starting to realize that, hey, things are actually working out. But they're clinging to this independence and needing to be right. I'm speaking of the Fed right now. And the media rooting for collapse, painting tariffs as a doomsday device to fit their bias. It's kind of sick when you see it for what it is, hoping for pain to score points. But here's the grasp that makes money and preserves wealth. In this VIX, it's anything but Goldilocks. We're in zombie land at 15.7 with that thin air with the highs associated with those highs, and screaming a huge void below. We have to lean into our 0 DTE butterflies as your daily engine. Low debit, regime-sized wings. Now, what that means, when I say regime-sized wings, I'm always referring to volatility regime, and we size our wings of our butterflies based on where we are in that volatility regime. And right now we're in zombie land. I'll just move over to it so that you can see that. Let's see, will the first click bring us there? Oh, yes, it does. Right to the VIX. I'm always surprised when that happens. But anyways, you can see how I've split up the VIX into 3 basic regimes: Zombieland, Goldilocks, and Chaos Zone. And that really dictates the width of our exposure, right? So right now we're looking at out-of-the-money butterflies that are 20 to 30 wide. What do I mean by out of the money? We're playing these things way out of the money. We do not play them at the money, because at the money will give us a really poor risk to reward. And by pushing them way out, we get anywhere from a 1 to 9 to 1 to 50 asymmetry. And that's what gives us our power. It allows us to keep our wealth by minimizing our losses if we're wrong. And if it goes in our direction, we make bank. 50 times our money sometimes. So that's what we're after. So that's what I mean by regime-sized wings, entered on reactions for that 1 to 10, 1 to 50 asymmetry. So we size our bets in such a way that no matter what happens, if we lose, it's absolutely no threat to our wealth. In fact, we could lose dozens of times in a row and it would still be no threat. But when we win, and those wins come regularly, when I say regularly, I'm saying these huge wins come on a frequency of about 12 to 20%. And the reason for that is that the market is perpetually underpricing expected moves. And so the market prices all of their options based on their expectation. Now they're not banking on these outsized moves, and that's where we're sitting. That's where most pros are sitting. If it even goes towards our price, we start making multiples on our risk. If it hits inside of our profit tent, then our return is incredible. Like I said, 30, 40, 50 times the risk. So that's the game that we're playing. And that's what gives me, in my account, my high Sharpe ratio. That's the amount of return I get per unit of risk. And my Sharpe ratio in my accounts, and also our followers, are on order of pros and high frequency trading. Imagine that. A discretionary trader trading at the same kind of character as a high frequency trader. But that's what happens in our system. So for convexity stack layer, we're looking at 3 to 5 DTE. If the FOMC hawkishness clashes with tariff realities, riding expansion south while capping downside. So what does that mean? That means that we're pushing these asymmetric trades out 3 to 5 days. And so yesterday I positioned it for today through Friday. And because of the big move down, a lot of those positions were taken off because they paid off big, even though they didn't get all the way into the profit tent. So I put the first ones on and, 1 to 3 days out, and then some 5 days out, or actually it would be 6 days out for next week, if the Fed decision comes in. But even prior to that, I was predicting a pullback. So we're looking for today, if the Fed is still stubborn and doesn't change their narrative, I believe the market will drop even further. And then what I had predicted or had positioned for will become a reality, and then those positions that we put on will pay off huge. All right. So imagine putting on a bet for, say, $70 and it returning $5,000. That's what I'm talking about. All right. So, as I said, these trades are the names that I have them are Convexity Stack, Sigma Drift, and the Sigma Drift one is the further out one. The Convexity Stack is between 3 to 5 DTE, and the Sigma Drift is 5 to 10 DTE. And they're around this post-decision catalyst for a mid-tail convexity position without predicting, harvesting if the narrative shifts and deflates further. We're also putting on what I call seed vaults. They're deep out of the money for insurance. So besides our trading capital, we also have our portfolio. And so we'll do the same thing with even further out of the money plays, and we call those seed vaults. They may be between 10 and 30 days out, or up to 90 days out. And those are waiting for those existential moments, like the tariff pullback that we had, or COVID, or the great crash. When those types of events happen, that's when our seed vault trades kick in. They provide insurance for our overall portfolio. So it's cheap wealth preservation. It's kind of like it is insurance, in fact, against any media amplified panic. Now, what is the path? We're going to reflect more before acting. What's the bias in seeing tariffs as brilliant versus potential trap? Well, if we're wrong, our small size ensures that we're going to survive. This is sovereignty. Make money on the echo, preserve through optionality. So let's reflect on this. Action is the goal, and the loop is life, and the risk is yours. All right? So that's my report for today. Hopefully, I threw in a lot of our convexity jargon in there today, and I'm trying my best to explain it. But anyways, let's continue on with our 0 DT analysis. We know we're going to be 20 to 30 wide. This is for today's trade. For DTEs outside of today, basically what we do is we put on a 50 wide fly. We push it further out of the money. If we're doing the NDX, it will be up to 150 wide. Push it further out of the money until we get to that convexity price. The convexity price is the price where options are super expensive, then all of a sudden at some level they drop like a rock. And that's the point of convexity. That's where the rate of decrease is accelerating. And we call that convexity. That's the point where the market has said, we're not interested in that. That is also the point where those 20% of underpricing of expected move happen. And so when they do, that's the point where we make big money. And like I said, we don't have to win very often to make huge return. All right, I'm sorry. I'm harping on this a little bit too much, but let's go on to our 0 DT analysis. 30 wide. We are now below the moving average, so we're going to change the directional bias to, let's make that bearish. Hold on. And if everything goes the way I hope it does, and the way we're betting, then we're going to come out of this with some very happy campers. We already have, actually. We've already made money. So we've made enough that it will last us right through this. In fact, we made enough money yesterday to pay for the next half year of losing bets. All right? To give you an idea. And so we're bearish. And let's take a look at the market structure. All right, so this is where I actually made yesterday's announcement here. So we're in the midst of a volume node, and I can tell that by the coloring that I have on these volume levels. So what I do is I go to the profile like this, right? and then I mark it up here, and then I colorize the node so that I can see the levels in the low end. And when I'm down here, I actually don't need the volume profile anymore because I can see exactly what I'm looking at. So right here, I can tell that I'm inside of a node. And so the green is the bottom of the node, the red is the top of the node. And then these blue lines are deep crevices inside of that node, which also provide support and resistance, as you can plainly see. So we'll be looking for 0 DTE plays that play out something like the following. So when the market opens, we'll be looking for things that come up to here. Actually, I could even consider doing this right now. So if it comes up to there, then you're looking for it to bounce off of that level. It could just as well, pop up to this level, or even above, maybe up to here. Whatever happens, that's going to be the event that we're waiting for. That's our excuse for getting into the trade. Right here, these vertical blue lines are showing the time frame that we're interested in this trade. That's what we would call the morning session. And so that works also for the NDX or the NQ here. So we're looking for basically the same thing. So you can see I've drawn out the volume levels here. I just need to map out the morning session. And so we'll be looking for something very similar. All right. So there you go. We know everything that we need to know about the market. We know our exposure, how wide we're going. We know the direction that we're going, and now we're just waiting for that event that will get us into the trade. Now, some of the trades were now that's for a 0 DTE trade. That's how we roll every day, and we mix our 0 DTE with our longer dated options trades, the convex stack and sigma drift, and the seed vol trades. So they're all running simultaneously. They're kind of overlapping each other. They provide us a super wide net of huge convexity, huge asymmetry. So it ends up that our win rate ends up being around 50-50, but our return and our Sharpe ratio and the amount of capital that we make per unit of risk is off the chart. So what our equity curve ends up looking like is just a tiny little bottom left, top right type of thing. And I'm going to go over that later this week. I'm going to show you past accounts that I've run inside of our coaching service, and how they're used as a reference account, and then I'm trading a much larger account. So this system is absolutely scalable from very tiny accounts to 7-8 figure accounts. What I'm going to show going forward publicly is I'm going to start trading I think about a $350,000. I'm going to start with a $350,000 account and trade this system every day, and then report back to you the results so you can see it in relative real time. Oh, we just got a big drop here. Let's see, what time is it? It's 8 o'clock. I'm not sure exactly what happened there, but the market. See, if we were positioned off of that and taken that trade, that would have been a pretty cool trade, huh? But while I'm talking, I can't trade. So we got to drop the show and get back to what's most important. Let me get back to the big head. All right. So you see what we do. We're evaluating the market. We're looking at volume profile, looking for liquidity structures, looking for convexity. Systemic risks. We're positioning ourselves for those risks. We're taking super small risk on our trades, but huge potential if they hit just right. Even if they don't hit just right, if they just partially hit, and that's what happened yesterday. I put on a few trades. They cost me maybe 70 cents. That translates to $70. The market moved sharply, like you saw, and they paid off. Most of those trades paid off 200, 400, 600% return on the risk. That's what I like. Now, crazy part is if this continues and our further out of the money trades hit, we might see 2,000, 3,000, 4,000% return on the risk. I know that all you options traders out there are just creaming your jeans when you get 10% on your risk, right? And then you're sweating every day because you're trying to manage that risk. We don't manage risk here. We manage profits. It's a whole different mindset. We never have to worry about the risk. We sleep at night, right? So that's it. If you want to learn how to trade this way, go down below to the description and join our Fat Tail School community where you'll learn the entire strategy. You'll get 2 coaching calls a week. And if you want to move up from there, you can join our coaching service. All right, there you go. That's it for me, Dude from Earth, Coach Ernie, and I am out.